All right, so we are a little past noon. So thank you for joining today's session. Today we're going to talk about the wheel strategy. And if you don't know me, my name is Jessica Inskip. I'm the Director of Education and Product here at Options Play. My job is to make sure that we understand all of those complex financial concepts that our options are inherently known for, and then bring that application together via our product. The wheel strategy is a strategy by name growing in popularity in terms of searches, but it's the way that options traders utilize short options on a covered basis to buy and sell securities. So we'll go through that in a lot of detail today. One of my favorite presentations to discuss and educate on. So excited to dive in. If you've never attended an Options Play education session, know that this is Options Play's motto on the education arm is we want to empower you to trade sustainably and confidently. And that just simply means from an education basis. It starts with financial literacy. When you are financially literate, options or not, you make better decisions. You're supported or educated decisions. So just taking that understanding is always a step towards confidence and trading sustainably, if you will. Now, before we dive in, we have to cover a couple of disclaimers. Know that there are securities that we may talk about. It's purely for informational and educational purposes only. Options are complex and they are not for everyone. They require a separate agreement. There's also a lot of terms. We're going to cover a lot today as this is an education only session. However, there's a document that you've probably seen on First Trade's platform. You can also get it on the OCC.com. It is called the Options Risk and Disclosures Documentation. That goes over the risks associated with options because, again, there are complexities there because it's a derivative security, not only derived off of the underlying, but it involves so many other factors. So there's this document that the OCC has put together that you can certainly check out. Also, this webinar and video is not intended to be individual tax, legal, or investment planning advice. All examples are for illustrative and educational purposes only. Examples do not include any commission or fees, and Options Play is a third party not affiliated with First Trade or its affiliates. So any opinions are stated are that of Options Play and not reflected of First Trade. Okay, so what are we going to talk about today? First and foremost, what is the wheel strategy? What is the strategy that is searched upon so much? What does it mean? We'll break that down in detail and then I'll bring back this graphic. We'll review covered puts and calls. So give you an insight of to what it is there. So hopefully there's a hint. We'll go through some examples, what that would look like in different types of markets. We'll talk about defining optimal covered puts and calls. We'll talk about some opportunities and trading tips along the way. But what I want you to focus on is how can I maximize yield and participate in capital appreciation while utilizing options? That's the question we're going to answer today. So, what is the wheel strategy? We'll say this is the infographic that we spent the most time putting together. But this is essentially what it is. It is a wheel where you utilize options to buy and sell stock. Well, whenever we have an option, there are normally two outcomes. Hence the word normally. We sell a put, it's either going to be expired or we will and in terms of the wheel strategy, you can trade it on the secondary market, which is not depicted here, or we allow it to be assigned. So if you do nothing, it's going to be assigned or expired, either way. And then this happens with the call side. So I'll bring this all together and we'll talk about this. This is not the only time you will see this. I'm just going to give you this to digest for now, and then we'll dive deeper. But the intent of the wheel strategy is to create continuous income. Whenever we're selling an option, you collect an upfront premium. And that upfront premium acts as continuous income. And the income is just the frequency that you sell those options. We'll talk about that in more detail. It allows you to purchase the stock at a discount in comparison to the current market price. And that really does depend on your strike price selection. So we're going to talk about that in more detail. And it allows you to participate in capital appreciation. You participate in capital appreciation once you own the underlying security, which happens during the assignment process, if assigned, when you sell a put. So we'll go break down these terms. So if any of this sounds foreign, do not worry. We've got some basics that we'll cover as well. So what is a covered call? Start with a covered call, even though this is the second part of the process, because it's the easiest to wrap your head around. And so we'll dive deeper here. If you have never seen a profit and loss diagram, this line right here represents you owning the security, meaning as the stock, this is a number line. So imagine the stock price going down and the stock price going up. As the stock price declines, you have substantial loss potential because it could theoretically go to zero. You purchase Apple, you purchase whatever security, it could go to zero. That's your maximum risk. That's your capital that you're putting out. That is the risk. The most you can lose is the most that you invest. Your max gain is theoretically unlimited when you're purchasing a stock because it could go to an infinite price. There's no cap. So in order to create a covered call, first you have to own an optionable stock or ETF. And since one option generally represents 100 shares, you need to own 100 shares in order to cover it. Because a call contains the right to sell. And when you sell the call, a call contains the right to buy. And when you sell the call, you create an obligation to sell. So you sell a call option utilizing the stock as collateral and you receive a premium. So the stock that you own, since you have an obligation to sell, the way that you offset that obligation is by owning the stock. If you're obligated to a short call on an individual basis has unlimited risk potential because as the stock price goes up, you could be required to buy those shares at the market and then sell and at an infinitely high price and then sell it at that strike price that you've agreed upon to sell at, that obligation that you've created. The way that you cover that call is by already owning those shares. And that flips what we say the delta is positive. It makes it a bullish position at that case. But what you do is you're creating an obligation to sell the stock at a specific price. So that's the takeaway from this slide is when I'm creating a covered call, first I need to own 100 shares of stock. That's represented by this slide here. I sell a call option, which is this here, at a strike price where I agree to sell my stock, meaning you cap your upwards potential. So no matter how high the stock goes, you are obligated to sell at this price. That's how it caps your upwards potential. That's why strike price selection is oh so key. You receive a premium. So what that does is reduces your break even. So if you purchase the stock at 100, you receive a premium of $5. Your capital expense is 95, but you still retain substantial loss potential because you still own the stock. And if it goes down, you can still lose the same amount as we call that stock ownership risk. So with options, there's always a gimme and a gotcha or a give and a take. The give in this case is the premium. The take is upside potential. So we'll talk about that in more detail. A cash covered put is similar in the profit and loss diagram, but different because of the obligation that's associated with it. So we're going to talk about the buy side now. In order to create a cash secured put, you have to have the cash readily available to buy the stock or ETF. And remember, one contract represents generally 100 shares. So you need to have the capital available to buy 100 shares, and that's set aside as collateral. You sell a put option utilizing that cash as collateral, and you receive a premium. For then that example, that $5 you'd receive for an obligation to buy at $100 per share, for example, only, no commission and fees, that would allow you to would be required to buy at $100 per share, but that's offset by $5. So really your capital expense is $95 a share. That's where that's coming from. But you still have substantial loss potential because you're obligated to buy the shares, but you're creating an obligation to buy the stock or ETF at a specified price. So here's an example of ABC security and something that you would consider if you're the stock investor. And I want you to put this in the eyes of a limit order, if you will, because this is similar, but very different because we're talking about options. So if you were looking at ABC security, maybe you can figure out what security this would have been at one point, and it's at 50.72, and you are utilizing technical analysis or whatever it may be, and you say, you know what, if that drops down 72 cents, I'm going to put in a limit order. And I want to buy that security, 100 shares, when that limit order hits or the ask hits $50, it's available. And in order to create that order, you're going to have to set aside the full $5,000 to place that trade. And once you do that, you may want to sell at 58, where you might see an area of resistance or whatever your method is for defining those price targets. And in order to set that limit order, you put your shares as collateral attached to that order. Those shares, there's nothing you can do with it until you cancel that order because it's tied to the sell order, the sell limit at 58. So what you're doing is you're risking $5,000 to make $800 with these price targets in mind. That's the stock investor's eyes. So what I want to do now is shift from the stock investor, and we're going to compare if you're a stock investor versus a stock and options investor. What does it look like in different scenarios? We'll give you the good, the bad, and the ugly. That way we can understand it and wrap our heads around it. So going back to that buy limit order, if we're going to buy 100 shares of ABC at a $50 limit, we're going to take $5,000 cash and we're going to set it aside. Our account's debited $5,000. This is a cash only account, we're assuming. For the option trader, let's assume this May 6th is 30 days out. They're going to sell one ABC $50 strike put expiring on May 6th and receive a credit of $315 in this example. This stock an options investor has to attach $5,000 to this because that's the collateral, something the systems will automatically do for you. They're credited, though, up front, $315. So what that means is the stock and options trader has created an obligation to buy 100 shares of ABC at 50. They have 5,000 as collateral. They receive $315. They've already reduced their capital expense by $3.15 per share. So the option break even is $46.85, whereas the stock break even is the $50 of the ABC 100 shares of ABC at $50 per share when ABC is at 50. Now, something to note when we go through this sequence, this ABC 50, when we see the changes here, is going to be based off of the original price, not day to day. And I'll remind you. So let's say that 30 days from now, the ABC went up 2% by $1. Here's what happened in this scenario. The stock investor, they made 2%. They made $100 per share. Easy math, right? The options investor, they sold a put. The obligation to buy did not kick in because remember, a put contains the right to sell. So the right to sell at 50 is less favorable than the market. So therefore, this expired worthless. And when an option expires worthless on the sell side, you realize your maximum gain potential, which is the premium received. So this stock and options investor realized the option expired, the collateral was added to cash, they made 6%, the 315 that they received. So see how we look at it in terms of percentage. So now let's see what we would do next. So the following Monday, let's say that was a Friday, we'll go another 30 days out. And this time the stock and options investor says, okay, well, the stock's moving up. I'm going to go ahead and move my agreed upon buy price up. So I'm going to create an obligation to buy 100 shares of ABC at $51 per share. I'm going to receive a credit of $3 for the next 30 days. So $300 total because it represents 100 shares. Let's see what happens in that scenario. So again, 5,100 of this is set aside as collateral, get another $300 added to the account. Now, if ABC goes down, and remember, this is from the original price from day one, we're at day 61, it's at $50. Well, this is going to be assigned because the right to sell at 51 is more favorable than the market price of 50. Therefore, this is assigned and we are obligated to buy those shares at 51 per share, but we still keep that upfront premium, but the 5,100 is subtracted from our account. The stock only investor in this case is break even, and we're up 10% in this case because the stock didn't go anywhere. This is a flat scenario when we're selling those two options. So now we need to move to the sell side of the equation since we own the security. In order to do that, we're going to create an obligation to sell. The stock investor is saying, you know what, I'm going on vacation or wherever they're doing and going to create a limit order to sell at 58. So it's going to sit there, and once the bid hits 58, it would be executed as long as the market exists. The options investor, because it's options, requires a little more hands-on work, and a little more attention is now creating an obligation to sell at 55. They said, you know what? I've reduced my break even already with this income I've received to 42.85. I'm okay getting out of this position at 55. I'm going to go ahead and take those shares, utilize it as collateral, and have an obligation to sell those shares at $55. And I'm going to receive an upfront premium of $2 per share. So credited another $200 for that obligation created. If we go, and this was 30 days. So now we go 30 days from now and ABC's at 52. So did not increase all the way to 55. This, again, is an expired situation because the call contains the right to buy. As we sell it, we create the obligation. We have the obligation to sell, but since it contains the right to buy, buying at the market price of 52 is more favorable than the right to buy at 55. So our obligation to sell does not kick in. So therefore, we keep the upfront premium. This is considered a worthless option, so it expires, and then we'd move on. So now altogether, we've collected $815, 16% off of our original $5,000 investment, whereas this ABC trader, little less hands-on work, has collected 4% because now the stock is up $2 from the original 50 is where we're looking at this. So now let's say we're going another 30 days out and we're going to sell to open another 55 strike. The stock and options trader says, you know what? I still want to sell it at 55. 30 days out, I'll collect another $2. They're credited $2 of upfront premium. Again, you can see how the break even was reduced again to 40.85. So this is the income coming in, reducing the capital expense. That is there, really the cost basis, not for tax-wise, completely different concept. So let's see what happens again. Now, let's say earnings came out and ABC did amazing and it blew through the strike price of the short call here and went to 60. So this is up $10, up 20% from that original $50 when we were looking at this scenario 117 days ago. The stock only trader, remember, they put a limit order of 50. So once that bid hits, it would have automatically sold at 58. So they collected $5,800, still made $800. They're a winner in this scenario. The stock and options trader, on expiration, that obligation is going to kick in because the right to buy at 55 is more favorable than the market. So therefore, the obligation to sell at 55 has occurred, but we still collected all this upfront premium. And this is a great example of understanding what I like to call upside risk and why strike selection is extremely important because we are capping our upside potential when you sell a covered call. And when you buy a stock, the intent, of course, is capital appreciation and for the stock to go up. So strategy selection is extremely, extremely important. And we'll talk about some best practices in order to do that next. So all in all, the stock and options trader made about $1,400, 28%. The stock only trader still made 16% in 117 days. Both of those beat the average mean of the market nonetheless, and that's a good scenario, but they both still have risk of the stock going down, which is important to note here. But one is utilizing consistent income and the other is a buy and hold strategy, if you will. So important to take note there. Now let's talk about choosing an optimal credit or an optimal covered call. We've got a older screenshot here. We do that on purpose just so you can see what happened in the past from Cleveland Cliffs. So no, this is an example only, purely example, very older screenshot. We're going to go ahead and give you the optimal expiration that Options Play utilizes. This is an Options Play concept. That's 45 days. And that's because of the concept of time value. There's lots of other webinars we've done with First Trade where we talk about the concept of time value that allows for theta decay. So we'll go ahead and do that. But I'm going to give you some options, and you'll see this in the options wizard on the First Trade Options Play tool. I've got a couple of different strike prices here. And I just want you to do an exercise in your head. Which one would I choose? And I'll give you some data points and exactly what they mean. If you were going to sell a call on Cleveland Cliff, say you owned it, and it's at 30.77, and we've got a 15 delta, a 20 delta, and a 30 delta. Delta, by definition, is if the stock were to move up or down $1, how much would the premium change? So a higher or magnified delta means an option closer to the current strike price. So there's your definition there. This is your obligation to sell. So an obligation to sell at 38 at a 15 delta is going to give you 63 cents. An obligation to sell at 36, 94. An obligation to sell at 34 will give you 141. You multiply that times 100, and that's your net altogether. The raw yield that you're going to collect on a 45-day expiration means taking the 63 cents divided by this, and that will give you this number. Annualized is assuming you're doing that constantly over a year period. So in a moment, just in your head, say, I would do 38, 36, or 34, and then we'll talk about each one. Probably already have that. Okay, so normally we do this exercise, and sometimes we put out a poll. A lot of times we'll get 34 because you'll say, oh, I'm going to collect 141. That is a higher yield. It's a higher premium. It's a higher delta. But what's missed from that is you're not accounting for capital appreciation. You're obligated to sell at 34. So you better have conviction that it's not going to go any higher than 34 when you make that decision. When you go to 38, you're allowing yourself $8 for capital appreciation. So when you have scenarios where it goes above your strike, you're creating that obligation to sell. So we want to make sure that there's balance between yield or income that you're receiving and the capital appreciation or the capped price that you're giving. It's your decision, but that's what OptionsPlay's tools are optimized to do. When you select a covered call, it's going to give you an idea and a starting point, and then you can adjust, and helping understanding these reasoning behind it will help you make those optimal decisions. So the optimal, if you are prioritizing capital appreciation, 38. If you're prioritizing yield, would be 34, but the 38 net would give you more because there's $8 from the 63 cents, and you still get 2%, 17% annualized. So things to consider when you are making your decisions. Let's talk about optimal short puts. So optimal expiration in the OptionsPlay 30 to 45 days. Again, that's considering the theta. This is optimal short puts when you are looking at creating, as in selling the put with the intent to buy the underlying security. So now we've got a 40 delta, a 30 delta, and a 20 delta. Flip everything on ahead. Same exercise here. We've got American Airlines at 1655 at the time that this was taken, which again, it's a while ago. Always fun to look back at these. And if you wanted to buy American Airlines, you'd sell the put 30 days out. Same exercise. Which one would you choose? And we'll go through each one. So one, I don't own the stock in this scenario, so I don't have to account for capital appreciation. But you do have to consider what I like to call upside risk, meaning there is this decision you make when you're creating the wheel strategy or utilizing a short put in order to buy a security. Does it make sense to buy the stock or sell the put? And that really comes down to capital appreciation and how far you think the stock's going to go. Because what's going to happen in this case, and 85 cents is still 5%. That is a healthy yield in comparison. That's because this has a high IV rank here. This is considered the aggressive one with the obligation to buy at 16. If this were to move down 55 cents and on this downward trend may be possible, then you would be obligated to buy at 16 offset by that 85. That's more aggressive, but we get more of a cushion we're creating. However, if it were to increase more than 85 cents, then we would have been better off buying the security because there's less upside potential. But it's very difficult to time the markets, but it is easier to be prepared and financially literate is what I like to say. So if we want to be a little less aggressive, then as in a cushion of downwards, if you feel the stock's going to move down further, then a 15 or a 14, but then we're not prioritizing yield, meaning there is no capital appreciation to prioritize in this case because we don't own the security. However, there is sentiment we have to consider because selling a short put is a good decision when you are neutral short-term, bullish long-term. A covered call and a cash secured put are neutral to bullish strategies. So tips for finding yield. Focus on stocks you're familiar with and comfortable with investing in. If this is something that you've have never deployed before. If you've ever heard that term, trade will let you know a lot of that, even from the stock investor, just means you understand earnings and revenue more from companies that you work at because you have exposure to it. The same applies here on finding yield. If you have traded Apple before or something like that, then that might be a place for you to start. Just as an example, if you have a smaller account, this is capital intensive. You can look at stocks that create an obligation to buy at a lower price. Remember, it has to be an optionable stock or ETF. And if you're looking for a high yield income portfolio, sort reports by raw return. Again, these are available on First Trade's platform. And then earnings are something to be cognizant of. Earnings create high implied volatility, which amplify premiums, but that's because high implied volatility or volatility goes hand in hand with uncertainty. There is uncertainty on which direction the security will go based on the outcome. Therefore, it inflates premiums. And because the premium is inflated, it will make the yield look attractive, but that also means capital appreciation is possible. So just be cognizant of that. Important to be aware of. All right, and then we'll have a couple moments for questions, and that will conclude. And I've got 4 there. Can I have a recording? First Trade will send out the recording after this, and they post it to YouTube usually. Sanjay says, are you going to cover how to choose the ideal strike price for a cover call? We talked about that. Thank you, Sanjay. And insert that one. And Chris asked, during the month, the stock could have spiked to 58. The stockholder would sell at 58, but if by expiration price after 54, you get the picture. Yes, that does happen. So we were looking at the scenarios of what happens at expiration. During the month, it could spike up, or stocks can move in patterns absolutely and drop from there. And the only way that you avoid assignment is by closing out the position. But we are structuring the wheel strategy with the intent of being assigned as buying and selling. It is important to stress that it's all important where the price is on expiration date for the, yes, of course, we discovered that. And all right. So what I do want to do is go back to that original, as I said, I would bring it back up. So I want to make sure we do that one more time. And hopefully this makes sense as the intent of the wheel strategy. Is the creating of the continuous income. There are 2 outcomes when we're intend on holding these till expiration, to some questions there. So we sell a put to collect a premium. We're either going to get, with the intent to buy the stock, we're either going to get assigned and buy the stock or expired. And if it expires, we just continuously do this until we own the security. Once we own the security, we sell a call, create the obligation to sell the stock, and that's how you participate in capital appreciation. This is how we purchase the stock at a discount. We now start participating in capital appreciation. It's either going to expire or we get assigned and sell the stock. So if it expires, we continuous income, and then we sell the stock. And then if you're still bullish on the security, then the wheel continues. So that's why it's called the wheel strategy. It's literally just a turning of these 2 wheels, which ultimately make one altogether. And it's a way to buy and sell securities utilizing the obligations found within the short options. Okay. So I think we hit time there and we answered most of the questions. Any more, please send your feedback to First Trade. Always love hosting these sessions. So thank you so much for taking the time to understand and educate yourself on options today. Always a pleasure to do these. I hope everyone has a wonderful day and we'll talk to you soon.